for trading markets. Today we're going to look at the actual rules and results for the high probability ETFs trading strategy named the 3-day high-low method. Now this strategy works on both the long and the short side on ETFs, on sector and country ETFs, and we're going to get right to the rules. On the long side, these are the series of rules that we're looking for. We want to ensure the stock is in a long-term uptrend, and that's what the first rule does. The second rule through the fifth rule define the short-term pullback within the long-term uptrend. So what we're looking for is the close to drop below the 5-day moving average, and we want to see 3 days in a row where both the high and low were lower than they were the previous day. And we'll have a chart showing an example of a trade in just a moment. The rationale behind the rules is simple. We're buying ETFs on a pullback during a long-term uptrend. Now, for more aggressive traders, a way to increase the potential profitability of the system is to buy a second unit, and a unit is the number of shares that you're trading. So if, for example, you're buying 100 shares on your first trade, you would buy a second 100 shares under the aggressive strategy if the price closes lower than your initial entry point on any day after the trade is opened. Now, buying on an additional weakness is actually a low-risk strategy since we're dealing with a high probability trading strategy. And we'll have numbers to back this up. Now, if you were buying equal dollar amounts, if you were investing $10,000 on each trade, a second unit would be equal to $10,000. The exit will occur when the price closes above the 5-day moving average. Here's what the results look like. Amongst all of the ETFs, the average trade gained 0.66%. That's including all gains and losses. So it was net profitable on almost all of the ETFs. We do include all of the results here showing that, in fact, XLB was a losing strategy. But overall, we do have a profitable strategy, very high win rate of 76.9%. And we're holding positions just an average of 3.3 trading days. Now for SPY, the Spider S&P 500 ETF, 87.5% of trades were winners, and the average trade was a little more than 0.9%. These are the original test results that included 10 years of data or more and were published back in 2009. The aggressive trading version is even better. They increase the average gain to 0.98. That compares to 0.66. The average holding period is, of course, unchanged because you're buying on weakness and you're still selling when the close goes above the 5-day moving average. The percentage of winners also increases, and it does this because you're lowering the cost basis of the position by adding the second unit. So these results are logical and what's to be expected, but they demonstrate the power of the scaling in idea of trading. Here's a chart showing an example. Of course, we're in an uptrend. The 200-day moving average is not shown. This is the 5-day moving average that's highlighted. Here's the uptrend. Here's the first day where the high is lower than the previous high, the low is lower than the previous low. Here's a second day meeting those conditions, and then a third. Buy at the close on the third day. This is the non-aggressive version. So then you're going to sell on a close above the 5-day moving average, and that occurs 3 bars after you open the trade. Here's an example of the aggressive method. Again, we have the high below the previous high, the low below the previous low for 3 consecutive days. Buy on the close. The next day is a virtually unchanged day. And then the next day that the trade is opened closes lower than the initial entry price. Under the aggressive rules, we're adding to the position at that point, and on the close above the 5-day moving average the next day, we exit. Shorts are the exact opposite. The close needs to be below the 200-day moving average because we're trying to buy in a downtrend. We want short-term strength in the downtrend, which is defined as the close being above the 5-day moving average. And we want to see the pattern 3 days in a row of the high and low being greater than they were the previous day. The rationale is similar. We're selling short on short-term strength in a long-term downtrend. The aggressive traders will follow the same rule and short a second unit if the position shows a loss at any time after the trade is opened. And the close will also be similar, exiting on the close the day the ETF closes back below its 5-day moving average. Here's the results. And of course, short systems are notoriously difficult to identify. Quantifying a short strategy that works is a notoriously difficult task, but as you see here, 71.5% of these trades were winners. It was held for an average of 3.6 days, and the average trade gained 0.88%. These are extraordinary numbers for a short strategy. SPY, again, more than 80% winners, strong average percent P&L. As you can see, not every ETF was a winner during the test period, and the percentage of winning trades varies from 50% on up into the 80s. Aggressive trading version rules, again, increased performance. The average gain, average percent PL, now rises to 1.29%, and the percentage of winning trades rises as expected. Here's an example. The 200-day moving average is not shown again, but we have 3 days where we are moving higher. We're below the 200-day moving average. We have 3 days in a row moving higher with the high above the previous day and the low above the previous days for 1, 2, 3 days in a row. We enter on the 3rd day. The very next day, the close is back below the 5-day moving average and the trade is closed. The aggressive system uses the same series of rules for the entry. Again, we are trending higher for 3 days in a row. The trade is entered on the 3rd day. The 4th day, prices continue to rise, which means we add to the position. And then the very next day, the price moves back below the 5-day moving average. In summary, the 3-day high-low method has an extraordinarily high win rate, and it's also profitable with short trades. The strategy does trade relatively infrequently, with most of the ETFs offering a signal just 3 to 5 times a year. So to maximize the profits, we urge you to consider trading several high-probability, low-frequency strategies. We have several more strategies for you to look at on the TradingMarkets.com website, and we hope that you'll find, as we do, that they work well together.